What's up guys, it's your mortgage broker Brian here. I just want to make a quick video for those people out there who are considering purchasing a home but haven't taken that first step yet. So the first thing you want to do is get pre-approved. You want to show that you qualify for a mortgage at X amount. Okay, so you get in contact with a mortgage broker like myself, a loan officer, and go over an application. Now everybody's different, every profile is different, so these numbers, percentages, ratios that I go over are just going to be generic. So for income, we look at debt to income ratio. That's going to determine how much of a purchase price you're approved for. Debt to income is taking your debts and comparing it to your income. Now, as far as a percentage goes, it varies depending on the program and your qualifications. But just for this example, let's use 43% debt to income ratio. So let's say you make $10,000 a month. The most your debts can add up to is $4,300 a month. So what goes into your debt is your monthly payments that's reporting to your credit report. For example, your card payment, credit card payments, as well as what we anticipate your monthly mortgage to be. That's your monthly mortgage including your taxes, insurance, and HOA fees. Now all that together bundled up, the maximum amount that it can be is, in this example, 43%. Like I said, the debt to income percentage is going to vary depending on the program, your profile. I mean, I've even seen it get into the 60s, but for time's sake, that's a good example to gauge how debt to income works. It doesn't include other stuff like groceries, your auto gas, or things like that, so keep that in mind. The next subject we'll go over, and that'll be on the application, is assets. So money that you have, whether it's in your bank account, 401k, Roth IRA, it's what you have currently and or what you will have when it comes to closing. So we want to make sure that you have enough for not only the down payment but the closing costs. So let me give you an example here. So these numbers are not going to be exact, but just to give you an idea. Let's say you're purchasing a home for $400,000 and the closing costs come out to $6,000 and your down payment is $12,000. So we want to see that you're going to have, and you already have, $18,000 altogether to cover your costs. Now you're not expected to have that right off the bat, but we want to know at least when you're going to have it and where it's coming from. Now your down payment is going to change depending on the program you're going with. So for example, if it's a VA loan, you're not going to have to worry about a down payment if you're doing 100% financing, because it doesn't require a down payment, but you still have to show that you're going to have enough for the closing costs. And in our example, we need to show you have $6,000 to purchase a home. Or if it's an FHA loan, then your down payment is 3.5%, which is going to be $14,000 if the purchase price is $400,000. So you're going to have to show altogether you have $20,000 to get into the home, including the closing costs. Or with a conventional loan, if you're a first-time home buyer, the minimum down is 3%, so that $12,000 down payment plus the $6,000 getting you to $18,000 you need altogether. So just a few examples there when it comes to assets. Something to keep in mind. Now the third topic we're going to review, and that's going to be on the application, is credit. Now the better your credit is, better the program you qualify for, and the better deal you're going to get. But I've approved people with scores as low as 580. Now we'll pull a copy of your credit report from the 3 credit bureaus, Equifax, TransUnion, and Experian, and we will utilize the middle score. Now the scores you see on apps like Credit Karma are consumer reports, so when you pull a mortgage report, it could very well be different. But those apps are great to gauge, kind of see where you're at, if there's anything you can do to help improve your credit. Now it's a quick overview on what you can expect in the approval process. Once you're approved, you and your realtor will receive an approval letter, which you'll be able to utilize to place offers on homes. Now, if you don't have all 3 categories up to par, don't worry, you can still be approved. You'd be surprised how many people I've approved who didn't even think they would be approved and or were denied somewhere else. Being that I'm a mortgage broker, I have a lot more lenders to work with, which will ultimately not only allow me to find a better deal, but also a lender that will accept my client's current qualifications. My best advice would be to reach out to me if you're in Arizona, California, or Texas, and or a local mortgage broker in your area. Have a conversation, go over the approval, see what different things can be done. Like I said, there's a lot of different programs programs and every profile is different. And even if you can't get approved, they'll at least get a game plan going to where they can set you on the right track to get approved in the near future. Thank you for your time. My phone number is 602-756-8396. Website is briansloanteam.com. Reach out to me anytime with any questions, concerns that you might have. Take care.